Hello everyone. So welcome to the second episode of this course, Engineered Time and Price Theory. So we shall look at the basic PD arrays that we use for our model. So the first PD array is the fair value gap, rejection block, and order blocks. So we can start with the fair value gap. So the bullish fair value gap. So whenever price is trading higher, it will always leave what we call a fair value gap. So a fair value gap is what you see here. So price will trade higher and leave a fair value gap or an imbalance. So price at this level here, between this low and this high, price was not delivered efficiently. So price has to trade back lower into this fair value gap and deliver price efficiently. So whenever price trades back into this fair value gap, price is delivered efficiently, and with confirmation it can trade back higher after this level has been delivered efficiently. So when we trade higher, we leave an inefficiency, so we have to come back, fill that inefficiency, and trade back higher with confirmation. Much as like you are painting a house, you'll first paint the first time and come to rebalance the porous areas that you left behind in the first act of painting. So price is the same. It will leave an imbalance, then come back, fill that imbalance of fair value gap, then continue higher after delivering price efficiently. So this is the bullish fair value gap. So in charts you can see price was trading higher. So between this low and this high we have a gap. So price was not delivered efficiently at this level here. So you see price trading lower back into this fair value gap. So this bullish fair value gap, if we are bullish, it will support price higher. So price delivers efficiently, and after delivering efficiently it trades back higher. So if we are bullish, this bullish fair value gap will deliver bullish prices higher. So that is the bullish fair value gap. So you can go into your charts and practice how to mark these levels. You mark it from this high to this low, where you see price not delivered efficiently, that is your fair value gap. So if you're bullish, that level in the future will support price. So understanding PD arrays, the bearish fair value gap. So whenever price is trading higher, it will leave inefficiencies. Price will not be delivered efficiently. So price has to trade back higher and be delivered efficiently. So whenever price is delivered efficiently, price will trade back lower in case we are bearish. So you can see this is our bearish fair value gap. So we mark it from this low to this high, and we wait for price to deliver efficiently. So whenever price delivers efficiently and this fair value gap is traded into, if we are bearish, price will trade down lower again. So this is the bearish fair value gap. You mark it from this low to this high and you wait for price to deliver back into this PD array. So whenever it trades back into this and we are bearish, we shall trade down lower again. So this is the example. In the charts, we have this gap here, our fair value gap from this low to this high. So we mark the whole of that area. So if we are to trade lower again, price has to deliver efficiently back into this level here, and this bearish fair value gap will support price lower. So that was our first PDR, fair value gaps, and that's how we mark them. So we can go to rejection blocks. So a rejection block, so price will trade to a certain level, then it will create long wicks below. It could be 1 week or 2 weeks or 3 weeks, but we need to have a long wick below. So from this level here, from here to the low, that is our range. That is our range where we could buy from. So we can buy from this range high to this range low. So this is our buying range. So whenever price trades back into this range, that is our buying opportunity after a confirmation, as we shall look in the future episodes. So this is how a rejection block looks like. So price will trade into a level and it will create long wicks. So we look for the lowest body close and we mark that as our opening range. Then this becomes our range low. So in this range is where we look for our buying opportunity. So as you can see here, price trades lower. It creates a long wick here, long wicks at this level. So our lowest body close is here. So price trades back into this level, our rejection block. So when it trades back into our rejection block, you can see it supports price higher. At this level here, it trades back into this range again and trades higher again, delivers price higher. So that is the bullish rejection block. So for the bearish rejection block, it's vice versa. So you can see price trades into a level, then this is our opening range and this is our closing range. So in this range, this is our sell zone. So whenever price trades back into this sell zone with confirmation, we trade lower. So in the charts, this is how it looks. You can see price traded into this level here, then we have a long wick here. So this is our opening range and our closing range. So in this area here is where we want to take our sells. You can see price trades back into this green shaded area, our rejection block, then supports price lower. So we sell at that level with confirmation. So that is our rejection block at that level there. So the last PDR that we want to use for our engineer time and price model are order blocks. So for order blocks, we want to see, if it is a bullish order block, we want to see a bullish candle engulf a bearish candle with the whole wick. It should engulf the whole wick. So this is our bearish candle and this is our bullish candle. So this candle, the bullish candle, should engulf the whole of this candle, and we want to see this order block form at a key level. So it should trade at a key level, then we form this. So once we close above this wick, this is validated as our order block there. So for our order block, we have 3 entry areas. So the first place is the wick, then we have the open. We can enter at the open, or we can enter at the midpoint of this bearish candle, which is the mean threshold. So we can enter here, or we can enter at the open or at the high. So those are the 3 levels that you look at whenever you are using order blocks. So you wait for price to drop lower into those levels, then you look for a confirmation, then you buy. So you can see at this level here we have this candle which is engulfed by this green candle, the bullish. So when we close above that wick, that confirms that level as an order block. So we wait for price to trade back into that level, and you can see how that bullish order block supports price higher. So the bearish order block, same concept but dropping down. So we want to see a bearish candle engulf a bullish candle with the whole wick. So when we close below this wick, this is confirmed a valid order block. So when price retraces back into the low or the open or the mean threshold of this order block, the midpoint, we could be sellers into that level with confirmation. In case we are bearish, this formation, this order block will support price lower. So you can see price trades higher, then we close below these bullish candles, we close below them. So this is a single order block. We have these 2 candles, we join them, then they form a single order block. So we can mark the open. So I told you price can start supporting that level from the, can start resisting that level from the this week, or from the open or the midpoint. So you can see price is supported at the midpoint of this bearish order block, and we trade lower. So for our model, these are the 3 PD arrays I want you to look for: fair value gap, order block, and the rejection blocks. So go into your charts, correct those levels, and we shall use them in the future episodes. So thank you.